Good morning, everyone. You are watching live Daily Market Outlook for Wednesday, 16th of January 2013, prepared by Windsor Brokers. Volatility is back to the world markets as a single currency continues to trend lower following a 2 days reversal of recent fresh high at 134.00. As comments of Eurozone Finance Minister's Chairman Juncker, who said commented that the euro is dangerously high, triggered fresh profit taking from investors. Basically, the pair lost initial and strong 133 support. This was the previous strong resistance area, sliding so far to approximately 132.70 zone, with the more negative outlook seen in the coming hours as technicals for euro remain negative. From the other side, Japanese yen continues to recover after hitting a fresh 2.5 years high at 84.66, with the dips below 89.00, hitting so far below 88.00, hitting so far 87.90. We lost the initial 88.40 previous high support, and now denting basically 88 support that keeps more focused to the downside and sees potential for a further easing, further corrective action of the strong rally that so far peaked at 89.66, just ahead of psychological 90.00 barrier. Top performer is dollar Swiss that broke above key near-term support at 93.00 and 93.30 seen so far, with focus now towards the upside. Fibonacci barrier at 93.45 and more significant static barriers 93.80 previous high and 94 as psychological resistance coming in the near-term focus, with some corrective action seen on overbought conditions on the near-term studies, looking for a good support somewhere around 92.50 in order to keep the immediate bullish structure in play. From the other side, the commodities remain steady. Gold is basically holding above previous strong resistance and 16.78, also Fibonacci barrier, with the more focus seen at the upside and the possible test of 1694 and 1700. Our next upside targets. The gains were basically supported by yesterday's released U.S. retail sales that showed a solid rise in December as Americans shrugged off the threat of higher taxes and bought cars and a range of other goods, suggesting a momentum in consumer spending as the year ended. This was quite supportive for the for the gold, and especially that signals of further ultra low rates in the majority of world central banks will remain, turn the investors back into the yellow metal as one of the top safe haven instruments. Crude oil remains positive, consolidates basically recent gains that so far reached levels at 94, if I'm not mistaken, 94.68, with the price action still holding above psychological 93 and well above strong support and higher base at 92.64, seeing potential for further stretch higher as near-term technicals are still holding a positive tone. Another warning signal came from Fitch, a warning of U.S. rating status as the United States face a material risk of losing their AAA status if is a repeat of the wrangling seen in 2011 over raising the country's self-imposed debt ceiling. This was the comment from a rating firm Fitch released yesterday. The United States scrapped up against its 16.4 trillion US dollar debt ceiling in December 31st and is now employing special measures to meet its financial obligations. The Treasury Department said those steps could be exhausted by mid-February. Despite December's deal by U.S. politicians to avoid the fiscal cliff of spending cuts and tax hikes, Fitch's head of sovereign ratings said pressure on the country's rating was increasing, and if they repeat the August 2011 debt ceiling crisis, the Fitch will likely place the U.S. rating under review. These were the highlights for today, 16th of January 2013, and now we have the calendar for today. I think we have already release of the Swiss retail sales that is not yet in our calendar. However, consumer confidence in Japan significantly dipped following a 40.7. 2.9 is the release. 2.9% is the release of retail sales. Well, below expectation of 3.3, but still above October's 2.7%. Back to Japan's data showing consumer confidence in December dropped below the November's one at 39.4. Today's release is 39.2, but well below the forecasted quite optimistic 40.7. First, still to come, inflation from Eurozone due at 10 o'clock GMT for December. Yearly release shows no change in the CPI for December. 2.2% is today's forecast versus the November's 2.2%, but core CPI, according to the forecast, is forecasted to tick higher. Forecast is 1.5 compared to 1.4% in December, and then repeated the CPI data come from United States at 13.30. December monthly inflation is expected to stay at 0 versus the dip of 0.3% in the month of November, while core CPI in December is expected to raise by 0.1% to 0.2%, pardon, by 0.2%, as this is today's forecast, compared to 0.1% in December. Further data from United States, 1400 GMT long-term purchases for November. Expect a healthy growth of 19.8 billion purchases seen in November compared to October's 1.3 billion US dollars, with the capacity utilization rate in December showing improvement from November's one, according to the forecast, that is 78.6% versus 78.4% in the month of November. And this is at 14:15. At the same time, industrial production from the United States for December shows, according to the forecast, increase by 0.2% versus 1.1% growth seen in the month of November. And the housing market index for January from the United States due at 1500 GMT sees consensus at 48 compared to 47 in the December. Crude oil inventories are at their regular time at 1530 GMT, and the further build of crude stocks is forecasted at 2.3 million barrels build in the last week compared to the previous week build of 1.3 million barrels of oil. And that's basically all from the news and the fundamentals for today. We're going to take a look now at technicals and see the latest developments. As we said, the higher volatility is now seen in the markets, and sees potential for further easing for the single currency as the euro dips below important 133 support. This was the previous strong resistance area several times. Failed to break this, and followed by easing down to 130.00 with fresh strength, clearing it and hitting 134 next psychological barrier. Currently easing from there, that cleared, broke below 133.00. So far dipped to 132.62 with immediate focus now seen on 132.47, the higher platform lows of 11th of January. Also 38.2% retracement of the upleg from 129.96 to 134.01, and this is also reinforced by 55 days exponential moving average on the 4-hour chart that is slightly below this, underpinning this good support. However, the a reversal of the 20 days exponential moving average that now starts to point lower, and it's already below the price, with the 55 days one slightly turning towards the sideways, and the indicators sliding from the overbought territory, losing initial bullish momentum. Further easing of single currency is seen quite likely at this point, according to the technicals, as a loss of 132.47 could be a trigger for further stretch towards the next significant support round figure, and the 50% retracement at 132 level, where ideally any stronger reversal should be contained in order to keep the bullish bias of 129.96 and the higher low at 130.37 for possible renewed attempt at 134.00. Otherwise, the downside will come more into focus, and the near-term bulls will be put aside. Daily structure is still holding a positive tone and still sees the upside favored, with the current pullback seen just as corrective action, as most of the indicators are holding in the positive territory. A reversal of the stochastic still hasn't get the firm confirmation of the stronger reversal, so we assume that 132 should be a good support, and they should hold corrective dips in order to resume, in order to keep the near-term bullish structure intact for a possible further attack higher. For now, the near-term tone is dominating, and 133 being taken out, now offering initial resistance that is reinforced by descending 20 days exponential moving average, and any bounce higher should be contained somewhere around 133 or 133.35. This is the previous range floor that is expected for now to cap the upside, as the single currency is currently in the corrective mode, reversing pardon, of a recent peak at 134.00. And the cable remains under pressure after being congested under 161.00. We can see the several attempts here where the descending 55 days hourly exponential moving average capped the corrective attempts, and the fresh weakness that attacked initially 160.30 higher base now being lost, and immediate focus comes already testing 160.00 as more significant and strong support. This is part of 159.90, 160 higher base break, of which would be a trigger for some stronger reversal of the stronger reversal and the corrective pardon, action of the larger 158.26 to 163.80 ascent. Immediate risk is seen on a break below 160.00, 159.90. That will open 76.4% retracement at 159.60. This is also low of 28th of November, and then more significant is around figure psychological support and 200 days moving average at 159.00, as near-term tone dominates on the lower time frames, and the market is in the sharp down move. Most likely scenario is seen on a break below 160.00. That will possibly open the way for a fresh leg lower. Will signal an end of the congestion above 160.00 as part of consolidation of larger losses from 163.80. Break below 160, as said, opens 159.60 and 159.00. Absence of any data from UK today sees no support or pressure from the economic indicators. Dollar yen continues to dip lower in the corrective action of 89.66 2 days ago high, as the pair dips so far to 87.81, denting initial support at 88.40 previous high, and 88.00 as psychological support. This is also marking a 38.2% Fibonacci, pardon, 23.6%. I do apologize. We are wrong. 61.8%, pardon, Fibonacci retracement of the uplift from 86.81, pardon, up to 89.66, with the negative tone now dominating in the near term structure, seeing a scope for further extension, lower further retracement as the 88 so far has been dented. 87, 81 seen so far on the fresh weakness at the beginning of the European session. We're looking for a further stretch towards 87.48, Fibonacci 76.4%, and more significant is of course 87.00 and 86.81. This is the low of 9th of January 2012, and I would say it's seen as a break point at this point. This is basically our higher base. We have low at 86.75, 3rd of January, and 86.81 at 9th of January. Break below this level could be a trigger for some stronger corrective action and could confirm the near-term top at 89.66. As the hourly studies, hourly indicators are now breaking below their midlines, as said, more focus is now seen towards the downside, and possible extension down towards 87.45 initially, and then 87.00, 86.80 is seen as a likely near-term scenario. The notion is also supported by overextended daily studies that are starting now to point lower and emerging out of the overbought territory, extremely overbought territory, as RSI at certain point reach levels above 80, while all the other indicators are now pointing lower and seeing potential for some more significant corrective action as the pair remained in the unobstructed rally from beginning of October 2012, rallying from approximately 78 up to 89.66 insofar, with no significant corrective action seen so far. This could be a quite good signal. If we lose 86, 81, then we'll be talking about some more corrective action, although still the upside remains on the larger picture, remains in play, and this could be described as just corrective action unless we see the break below 86, 81 seen as a trigger in the near term. As said, the top performer of the past few sessions is the dollar Swiss, as it cracked the key near-term barrier at 93.00, fully retracing the recent 93.00 to 91.09 descent, and keeping a risk away from the strong support and base at 91.00, 90.80 zone, with the prospect for a stronger corrective action now seen as the pair broke above the trend line, broke above the 93.00 as initial and the key barrier, as well as 50% retracement of the down leg from 95.11 down to 91, from 95.11 correct down to 90.77. Said the more prospects seen on the upside as breaking above 55 and 90 days daily moving averages, and close above these levels. On yesterday's close above 93.17. That also marks closing above the 93.00 as previous resistance. Sees potential for a further stretch higher, where we have 61.8% retracement at 93.45, and then 93.81 is the high of 7th of December 2012, ahead of a more significant 94.30 zone psychological resistance, previous tops, and reinforced by 200 days moving average currently standing at 94.30. Corrective action on overbought hourlies is now already underway, with ideal support as 93 has already been cracked, seen approximately at 92 at or above 92.50 zone, where we have 38.2% retracement, and close to it is 55 days exponential moving average of 1 hour chart. Ideally, any deeper dips should be contained at or above these levels in order to keep immediate bullish structure in play for a test of previously mentioned 92.45, 93.45, 93.81, and 94.00, our near-term upside targets. Positive tone still dominates on the 4-hour indicators, with RSI now reversing from the overbought zone, seeing a potential for corrective action. The bullish crossover of 20 over 55 day moving averages is underpinning now the current action as the Bollingers are widening on the 4-hour chart, seeing again the potential for some further stretch higher after the corrective action is ended and the higher low left, ideally, as we said, at around 92.50 with initial support, previous high at 92.72 still in play. The crude oil holds still positive tone. It's better seen on the 4-hour chart following recent fresh high at 94.68, with the current movement seen rather as consolidative than corrective, with the 93 zone so far holding the downside being protected by ascending 55 days exponential moving average. And while we are holding above this level, more prospect is seen towards the upside, and the risk of stronger corrective action will be minimized. However, the descending 4-hour indicators with the previously signaled bearish divergence, bearish RSI, and the MACD divergence, seeing a risk of some stronger corrective action. Of course, sell-loss of 93.00 and the more significant 92.64 previous base would be a trigger for further stretch lower and possible test of strong support and breakpoint at 91.50. This is previous low of 4th of January, previous high of 28th of December, and close to it is the 91.14. Now it's the 200 days moving average. Basically on the daily chart, the bulls are still unobstructed despite the indicators starting to point lower. I would say break below 92, 91.50 would be a trigger for some stronger corrective action. Until then, we are still focusing the upside barriers 94.68 and then 95.00 and 95.00 as the initial, and then we have 96.79 Fibonacci 76.4% retracement of the larger 172 to 84.05 descent. And finally, the yellow metal that shows a good prospect for further recovery with a more bright outlook seen following the recent action that broke initially the 1670, the trendline resistance, and more significant 1678 previous high, and the Fibonacci 76.4%. Unfortunately, we don't have any Fibonacci retracement levels here. Approximately, this is the move from 1694 down to 1625 that marks 76.4. Sees prospect for a further extension higher, and possible test of next strong barriers 1694 previous high of 2nd of January and 1700 as a psychological barrier. Also, we have above these levels 76.4 Fibonacci expansion of the wave from 1625 at 1689 and 100% expansion at 1709. This is reinforced by descending main bear trend line, still tentative from 1795 peak of 5th of October 2012 through 1752, 26th of November 2012 highs. A break above 1700, 1710 is would be seen as quite good support for the yellow metal. Will avert immediate downside risk and look for some stronger recovery. Meantime, the 4-hour and the 1-hour structure holds a positive tone. Some corrective consolidative action cannot be ruled out based on the reversing hourly studies, with the current range floor at 1678 approximately offering good support. This is also the previous high and expected to contain reversal in order to keep immediate bullish structure in play. This is approximately also 23.6% retracement of the latest upleg from 1653 to approximately 1685. Since so far this is yesterday's fresh high. Basically, hourly structure is still in the consolidative corrective mode, but overall positive tone keeps the upside more in focus. and the only loss of higher platform at 1664. This is also close to this is ascending a 55 days exponential moving average, would be a signal for some more significant weakness. Otherwise, we keep the focus at the upside, 1684, 1689, and the 1700 seen as the next upside targets. And that was all for now from my side. Please, if there is any question or a suggestion, I'm ready to answer it now. If you have anything, you can submit it. Okay, if we don't have questions, then not to waste our time, we'll conclude today's session. I hope we covered everything that could be of interest for your today's trading. The most important news and highlights have been presented, and the technical outlooks also. So keep an eye on today's calendars. There are some quite important releases, especially the inflation ones from Eurozone and the United States. And until tomorrow, in our next session at 8 o'clock GMT, wish you a nice day, and as always, very good and successful trading. Good luck.